Assalamualaikum and welcome everyone. This is Nabila Mutin Chaudhuri. So today my discussion will be on one of the most important section of utility demand chapter, which is how change in utility demand, whether due to price change or tax, affecting social welfare. The topic I will cover for this section are the following: welfare effect of a price decrease, welfare effect of a price increase, introduction of a tax, why not, and last but not least, why not use the Hicksian demand. So we will analyze the monetary effect of this price and tax adjustments, and we will not take consideration of the difference in individuals' utility level because of two problems. One is within a subject criticism, only ranking matters where not the difference, and the last one is between a subject criticism where the utility measures would not be comparable among different individuals. So instead of trying to measure how much happier or better off people feel directly from a specific change in price or fiscal policy, we will calculate how much money the change saves people or will make better of them. So first, we will deal with the welfare effect due to price decrease. Two moneymetric measures will be employed here. One is the compensating variation and another is the equivalent variation. So the compensating variation implies the amount of money the consumer is willing to give up after the price decrease to be just as well off as before the price decrease. On the other hand, the equivalent variation implies the amount of money the consumer needs to receive before the price decrease to be just as well off as after the price decreases. So let's see graphically the compensated variation using expenditure function. This is our initial budget line with initial utility U0, and after a price decrease, the purchasing power of people get increased, and as a result, we will finally get this budget line with higher utility U1. Here the dashed line represent the adjustment of final wealth after the price change to make the consumer as well off as before the price change. So finally the difference in expenditure is CV is the function of P0 P1 W equals to dashed line minus BP0 W, which is our initial budget line. So this is the CV, which is also known as Hicksian wealth compensation. So in case of EV, our adjustment dashed line will be tangent of our final utility function instead of the initial utility function, because we know that EV measures the amount of money the consumer needs to receive before the price decreases at initial price level P0, and her utility level is still U0 to be just as well off as after the price decreases. So this is our EV, which is measured as difference in expenditure as our final budget line minus our test line. Now we will calculate CV using Hicksian demand based on the given condition which we got from the previous definition. Here we replaced our compensated wealth with our initial expenditure function, and this is our CV area. Due to price decrease, our Hicksian demand function goes upward, and this is our CV. And this is the case of normal good. Graphically, CV is represented by the area to the left of the Hicksian demand curve for good one associated with utility U0 and lying between prices P1 and P0. To avail the same level of utility before the price change, our ECV will be here with U0. That's why. However, in case of normal good, our shaded area of EV will be greater than our shaded area of CV, as it is associated with utility level U1. Now, in case of price increase, a reverse case will be seen here. Our Hicksian demand curve will shift inward, and our Hicksian demand curve associated with U0 will be greater than the Hicksian demand curve associated with U1. The definition of CV and EV will also be reversed here. The CV will be the amount of money that a consumer would need after a price increase to be as well off as before the price increase, and the EV will be the amount of money that a consumer would be willing to give up before a price increase to be as well off as after the price increase. So we can see that the area of CV is greater than the area of EV in case of price increases, which is the reversed case of price decrease. So the introduction of a tax can be analyzed as a price increase. However, the tax revenue is not our subject matter here. So let's jump to the welfare loss occurred in CV and EV. So this is the welfare loss in CV, which is the area of the CV not transferred to the government via tax revenue, and it is the area loss is the area of the EV not transferred to the government via tax revenue. So the question may arise, why not we use the Wallacean demand? Well, Wallacean demand is easier to observe, so we could use the variation in consumer surplus as an approximation of welfare changes. This is only valid when income effects are zero, as Wallacean demand measures both income and substitution effects resulting from a price change, while the Hicksian demand measures only substitution effects from such a price change. Hence, there will be a difference between CV and CS and between EV and CS. In case of price decrease in normal goods, our CV is this area and our CS is this area. So we can see that the total CS area is greater than our CV area, and in case of EV, when our good is normal, our EV area is greater than our total CS area. On the other hand, when we will consider inferior goods, we will see the reversed case where our EV is less than CS and our CV is greater than our CS. So this is the summarization of the previous graph, both case of normal goods and inferior goods, considering the price decrease and price increase in both case. Okay, that's all for me. Thanks for watching.